Good evening, everyone. My name is Jean Garraway, and I would like to introduce Pierre Tomacek. Pierre has an MBA, CFP, CIM. He's first and foremost a father of two beautiful young women, aged 23 and 18. He's also a certified financial planner with a CFP with Xperia Financial Group, Inc., a small business entrepreneur and an educator who also teaches at both George Brown and Humber College Business School. Pierre is a results-driven financial planning sales management professional with over 30 years in the Canadian financial services industry. He also teaches future financial planners at various financial institutions in their journey to obtain the CFP designation. And last but not least, he is also committed to give back to his community by being the chair of the education community of the committee of the National Policy Alliance of Canada, a leading African Canadian nonprofit organization. Welcome, Pierre.
Thank you. I couldn't have written that better myself.
Thank you.
Perfect. Thank you, Jean. So today or this evening, we're going to take a look at taxation, the top 10 taxation tips. We will start with a background of Canadian taxation, and then we will go over 1 through 10, my top 10, and maybe there'll be some bonus ones.
Who loves paying taxes?
Sure, love paying taxes, but hopefully tonight we'll kind of demystify taxes in Canada. So a bit of history, a bit of a background. In Canada, we pay taxes based on residency. So if you are a resident of Canada, not a citizen, doesn't matter if you're a citizen or not, but if you're deemed to be a resident of Canada, you're going to pay taxes on your worldwide income. So if you let's say you overstay your welcome, you're in Canada for 183 days or more, then you will be deemed to be a Canadian resident, even though you have citizenship elsewhere. And you're going to need to file a tax return by April 30th and include all of your income, not only in Canada, but overseas or back home. So you want to be cognizant of that fact. And plus, our Canadian tax system is based on what we call a progressive tax system. So the more you make, the more you pay. So as you could see on the right-hand side, if you make anywhere in between 0 to about 48, you'll pay 15%. On the next layer, if you make between 48 to 97, you'll pay 20 and a half. Then the next layer, 26, 29, and then if you make more than roughly about 214,000 in Canada, you are at the highest federal tax rate. So 33%. So everyone in Canada, regardless of what province you reside or territory, you're going to pay these federal tax rates. And then depending on which province you reside, and since most of us are in Ontario on this call, I've put up Ontario's tax brackets. So you're going to pay the Ontario tax rate on top of the federal tax rate. So if you make more than $220,000 in Canada, you're going to be at the highest marginal tax rate. So you're going to pay roughly 33 federally plus 13.16 provincially. So when we add the two together on that layer above roughly about 220, you're going to pay roughly about half of your money in tax, 46.16%. So this is the type of taxation that we see, that we touch and feel every 2 weeks from our paycheck. We see the pain and agony coming out of our paycheck every 2 weeks. But there's also other forms of taxes that is not as visible. There are sales taxes that you pay pretty much on everything. Unless you look at your bill, you're going to pay an extra 13% on all of your goods and services. So it is, there's a stats that basically says that the average Canadian roughly pays roughly about 50% of their income in one form of another of taxation. So let it be property tax, let it be GST, let it be CPP, EI, and tax deducted. All of that will impede your ability to reach your goals. So let's see how we could save a bit of those taxes. Now, taxation tax calculation is pretty much straightforward. If you only have one source of income, so let's say only one job, right? You have no other sources of income but the one job that you work for as a salaried employee, and it doesn't matter what type of job or position that it is. If you only have one source of income, then your employer, right, the administrator will be able to calculate just the right amount of tax that you should pay. So if you only have one job, at the end of the day, when you file your income tax, you should not owe any money to either the federal or provincial government because they know exactly Pierre makes $50,000 and based on making $50,000, he should pay this amount of federal tax and this amount of provincial tax. So the right amount is deducted from my paycheck every 2 weeks. Now, if you have multiple sources of income, so you've got two jobs or you are earning investment income, then your employer or the source of income that you're receiving, they're not taking the right amount of taxes. So as a result of that, maybe this webinar is for you if you have multiple sources of income and you want to be able to maintain all those multiple sources of income. So tax tip number one, no drum rolls, but tax tip number one. This is very much relevant this year and probably next year, but this year, definitely. Typically, in order to deduct your home office, you needed to run a home-based business. So if you had a home-based business in prior years, then you're accustomed to deduct a certain percentage of the expenses that are being generated by running your home-based business. But this year, because of COVID, most of us have are are basically working from home. And as a result of that, the government has given every Canadian or most Canadian, if they are working from home roughly about 50% or more of the time, the ability to deduct certain expenses that was not available in previous years. So in previous years, if you're running a home-based office, then you're accustomed to determine in so let's say I have either a house or a rental apartment. How many rooms do I have in my rental apartment? All right, I have 3 rooms in my rental apartment. Of those 3 rooms, how many of those rooms am I using as for business? So one of the 3 rooms I am using as business. So therefore, 33% of the house or the rental place is used to run a business. So as a result of that, you could deduct 33% of most expenses incurred in your house. So this is for individuals running their home-based office. So like I said, COVID has kind of leveled the playing field for people running home-based businesses and people that are not self-employed and not running home-based businesses, but as a result of COVID are forced to work from home. So now the government is treating these two individuals or these two types of professions in the same manner. And they're giving you the ability to deduct home office deduction. So there's two methods that you could follow with regards to home office deduction. The the first the first method that you could opt for is the flat rate method. So what that means, the government has basically said, you know what, Pierre, I know you're lazy. You don't like to file a whole bunch of forms. You don't like to tabulate how much my expenses are, how much I've paid towards the internet, how much I've paid towards electricity, all of my home expenses. Pierre, we know you're lazy, so therefore we're just going to make it easy for you, Pierre. A flat rate method, just take $2 per day times 200 days of the year, and you could claim, no questions asked, Pierre, a $400 home office deduction. Okay, so we don't need you to provide receipts. We don't need any supporting documents, Pierre. Just take a maximum of $400 and you could deduct that from your taxes. And the only thing that you need to do, Pierre, we'll make it simple. The only thing that you need to do is to complete this form and you just tick option 1 on that form and sign and you're good to go. And now you could deduct $400 from your taxes. So think of it as a deduction from your income tax. So you're deducting $400 from your income. Okay. So now Pierre's saying, okay, this is the option that I'm going to take, right? But then the government, they're smart. They really want you to take the lazy approach. But the better approach is to take the more detailed method, whereby Pierre, now you're going to do some calculation. And guess what? By taking that extra step, that extra approach, you could save a whole lot more than the four measly $100 that the government is providing you with the flat rate approach. So with that approach, you're able to claim the actual amount of home office expenses that you've paid and maybe other types of employment expenses, right? So if you're renting, or if you own your own home, you are able to use this particular method. The only drawback for people that own their own home and have a mortgage, you cannot deduct your mortgage payments with this method. But if you're renting, you could deduct a portion of your rent. And I have an illustration that I could show you on the following page. Now, having said that, if you're going to opt for the detailed method, then you are required, you will need to sign and complete a form T2200. All of these forms, all of this information, at the end of the session, I will provide you, if you provide me with your email, you could put your email in our chat room and our assistant will compile the list, and at the end, I will email you the presentation along with the forms that I have spoken about. So no need to take notes and feverishly start to type things in. I will provide you with all of the information required. So now let's take a look at the more detailed. So let's take a look. So now Pierre has to kind of run the numbers. So what I've done, I've taken an example of an average Joe who is renting an apartment for $1,600 per month. and utilizes about 30% of his rental accommodations. So 30% of the house that he's renting, right, is used for business. So if there's 10 rooms, then then 3 of the 10 rooms are used for business. If you use the square footage, which most people normally use, so let's say the total amount of square footage for the house or the rental apartment is 1,000 square feet, and 300 square feet is where your home office is, or is where you conduct your business. So in my situation, I'm in the dining room, so this is my business office per se. So therefore, if the dining room is 300 square feet and the whole house is 1,000 square feet, then I could claim 30% of my eligible expenses towards the home office deduction. And now we're going to look at all the various deductions. So let's assume that average Joe pays $1,600 on a monthly basis towards his rent. 30% of the $1,600 would be the amount that he could claim as a deduction for the home office deduction. So if you were to do $1,600 times 30%, that gives you, of the 1,600, $480 on a monthly basis is the amount that he could deduct. You multiply that by 12 months, and that gives you $5,760 that he could deduct as a home office expense. And then you're going to need to tabulate your gas, your hydro, and your water, your utilities. What's the total amount that you've claimed for 2020, and you multiply it in this situation by 30%. Your monthly internet plan. So this has got to be they're going to base the monthly internet plan on a basic coverage. So if you've got a plan that's up to the wazoo with bells and whistle, they're only going to base it on the basic plan. So if your plan has everything, right, and you're paying $200 a month, they're going to look at what is the basic plan from Rogers, from Bell, and so on. So a basic plan runs about $75 on a monthly basis. So you would claim 30% of $75 multiplied by 12, so you could claim $360. And then in my case, I have office supplies. So I do financial plans for my clients, so I will provide them with folders. I need to buy highlighters, notebooks, I have envelopes, I mail stuff, I buy pencils, papers, stationery. All of those costs I'm going to need to tabulate. I know it could be tedious, but it could definitely worth the while if you use some office supply, and then you tabulate the entire cost that you use. And again, you multiply it by 30%, and that will be your home office deduction for office supply. Phone expense, again, basic phone expense that the government is looking at. So again, if you've got all the bells and whistles on your cell phone plan, right, then that may not be applicable. But it needs to be a cell plan for employment use only. So if you have a cell plan for your employer, then this will be available to you. And then if you are an employee who also earn commission, these extra expenses are only available for employees who earn commission, not for individuals that are salaried. Only if you earn commission. So that would be great if you're a mortgage broker, if you are a salesperson, and you earn commission, then you would be able to deduct a portion of your property taxes a portion of your home insurance, and the leases if you're leasing your computer and tablet. In this situation, I'm using Average Joe, and Average Joe is not a commissioned salesperson, so he is not able to claim those expenses. So now, when I add all this up, $7,700 I could deduct as a home office deduction compared to the lazy method, right? The lazy method, which basically said, Pierre, we'll just give you, you don't have to do anything, we'll just give you $400. So what would you rather claim, 400 or 7,000? Well, thank you. Thank you, Gene. 7,000 for sure. All right. So that to me is probably um, a very that is probably one of the better ones that you probably want to be cognizant of and take advantage of. Take the home office deduction if possible. And on the right-hand side, you'll find some non-eligible expenses. I won't go through them all, but basically mortgage interest is not applicable. Thank you, Eric. And other expenses such as capital expenses, such as rent. All right, tip number 2, maximize RSP contributions. That's pretty much straightforward, but I will show on top of maximizing ways to maximize your RSP contribution. I mean, I know I'm given a lot of questions whereby individuals say, should I maximize my RSP or should I maximize my TFSA contribution? And there's no one simple answer. It depends on your personal circumstance. If you need the tax break, then I will say try to maximize your RSP contribution, and with the refund that you generate with your RSP contribution, then use that refund to contribute to a TFSA. Okay, and to determine how much you can contribute towards an RSP, your notice of assessment will provide that to you. So if you go on my account on the Government of Canada CRA website, you will be able to see your 2020 notice of assessment, and they'll be able to tell you how much you could contribute to an RSP this year. The only drawback and caveat is, unfortunately, the deadline for RSP contribution has passed. It was March 2nd, 2000, of this year. So at this moment, if you haven't made an RSP contribution, then you would not be able to do that. Now, when it comes to RSPs, let's say I don't have money, right? And that's usually a lot of the problems for the average Canadian is, you know what, Pierre, I know it's 18% of my previous year's income, right? And if I made 100,000, that's $18,000 that I could contribute to my RSP, but I don't have $18,000. Then if you don't have the actual cash, you could actually make what is deemed an in-kind RSP contribution. Right? So you are basically transferring assets that you already own. So let's say you have non-registered investments, right? So non-registered, so that would be investments other than a TFSA and an RSP. You've got money, or you've got shares of any particular company. And I think I put an example of Apple shares that you own not inside an RSP or a TFSA. You could actually transfer those Apple shares from your brokerage account, non-registered account, as is, and put it inside your RSP, and that will count as an RSP contribution. But now we've got to be cognizant. A lot of times the government gives it and the government takes it away. But when you do such a transfer, you will have what is known as a deemed disposition. The word deemed disposition basically means it's as if you sold your Apple shares. So if you sold your Apple shares, you may have a capital gain. And if you have a capital gain, then there will be tax implications. You will have to pay tax on the capital gain that you generated. But that capital gain could potentially be negated or deducted based on the RSP contribution amount. So the RSP contribution could potentially wipe out the capital gain implication, which would make it a net zero transfer. So you would make an RSP contribution, get the RSP deduction, and still maintain your Apple shares. You will still own the same amount of Apple shares, and now you've just made an RRSP contribution. The same thing could be said whereby you could transfer in kind your shares or your investments, your mutual funds, segregated funds in your TFSA or non-registered. You could also do the same thing. Transfer it as is into an RSP and receive the contribution tax receipt for doing that transfer. So you really didn't take any money from your bank account. There was no cash that changed. We just put money from this envelope and put it into this envelope and transferred as is, and we made an RSP contribution. Okay. So far, so good. I will take it as a yes. All right. Income splitting. Income splitting, this is a strategy that is basically only works if you have a spouse. If you have a spouse, then you would be able to split the income with your spouse. Now, if you don't have a spouse and you have children that are 18 years or older, you could also take advantage of this tax planning strategy. And really what we're doing, we have income splitting works where we have an individual, a family member who is in a high tax bracket, and we have another family member who is in a lower tax bracket. And we're trying to split the income evenly between these two individuals, right? So that works well, where we're going to try to shift some of the assets and some of the income to either your spouse or a family member that is 18 years or older. It does not work if your child is younger than 18 and they haven't reached the age of majority. The government will throw some hurdles at you, and they will add what is known as an income attribution rule, and the income will be put back into your tax return, so which defeats the purpose altogether. So income splitting, basically what it does, if will reduce the higher income spouse or the higher income earners overall tax bill a great deal. And if you are 65 years and older and receiving OAS, old age pension, and the government will determine that if you make too much money as a pensioner, the government actually takes back, they claw back the amount of your OAS pension. So if you make roughly about $80,000 or more as a senior, age 65 or more, then the government will say, well, you don't need our help. So that's $7,300 annually that we give you in terms of OAS. We want some of it back, right? So we want we will want some of that back. And if you make way too much money, if you go over a certain threshold, they won't even give you OAS. They will claw it back. So this strategy will also work for individuals that are 65 and older and earning an OAS pension. And we'll also create a pension tax credit. So if we have a spouse that has never worked or doesn't have a pension, then by splitting the income, by splitting the pension with your spouse, you would be able to provide them with a pension income tax credit and further reduce the tax payable. All right. So now let's take a look of what I mean. Let me give you a visual. All right. So let me give you a visual. I think I'm a visual person. So kind of give you the progressive tax rate that I showed, except of giving you the exact number, I just approximated, right? So from 0 to 49,000 federally, you pay at 15%. From 49 to 97, you're at 20 and a half. 97 to 150, 26, 29, and 33. So now we've got two families, all right? We've got family one, each spouse, they each make 49,000. So their gross income is 98,000. And then you have family two, one spouse stays home to take care of the kids and the other spouse goes to work and make $98,000. So when we look at family one and family two, we're saying, you know what, they make the same amount of income. But from a taxation standpoint, the amount that they'll have after they pay tax, family one will be in a better position than family two. Family one will have more money in their pocket than family two. The simple reason being is that family one is in the yellow tax bracket. So their income is taxed at the lowest tax bracket, 15%, whereby family two, the one member is in the blue tax bracket. So therefore, they're going to be paying more taxes as a family. So the best thing to do would be, you know what, spouse number two in family two, why don't you give some money to spouse number one, right? The government realizes that, and again, they'll throw some hurdles and they'll say, you can't do that. You're not able to just give income to your spouse. And if you were to try to do this, then the government will attribute back the income that you gave to spouse number one. So there are some specific things that we could do that family two could do to be more like family number one. And those are some of the income splitting strategies. And here are some of those income splitting strategies that family two can employ to be more like family one. So one of the things that we've talked, if you're earning a pension, right? So you don't have to be 65 to get a pension. Some people, depending if you're, what type of environment, which type of plan that you have, is it a defined benefit? Is it a defined contribution pension plan? Some people, especially firefighters and police officers, they could start a pension a lot of times as early as in their early 50s. So if you're earning a pension, right? You could split that pension income with your spouse. And I've talked about a lot about spouse, and I guess I should also clarify what spouse is. So spouse is not just someone that you are legally married, that you legally married with. Spouse could be a common law partner that you've lived in a conjugal relationship for 12 months or more, either same sex or opposite sex. From a tax standpoint, there is no difference. So if you are living in a conjugal relationship with a partner for more than 12 months, that partner for tax purposes is deemed to be your spouse. And as a result of that, you could split income, take advantage of some income splitting strategies to minimize the family's overall tax burden, by shifting income from a higher income spouse to the lower income spouse. Another income splitting strategy is you should have the higher income spouse pay for all of the living or lifestyle expenditures and have the lower income spouse or the lower family member invest in their name only. The reason being is that if the higher income spouse was to invest in their name, whatever income that's being generated will be taxed at this high rate. Now, if the lower income spouse invests in his or her name, then whatever income they generate will be taxed at this rate. So as a family, we've got more money in our pocket to, to better enjoy our quality of life. Another income splitting strategy, because if you have a lower income spouse and a higher income spouse, and it's for these strategies to work, it's got to be significant. I mean, if you make about the same amount of money, one person makes 60, the other one makes 50, it's not that significant to be employing these type of strategies. It may still be relevant. You may need to speak to a financial advisor to really determine if certain strategy will still be relevant if you make about the same amount of money. But really what we're trying to do, if you are a higher income spouse while you're working and you have a lower income spouse while you're working, then guess what will happen at retirement? The same thing will happen. The higher income spouse will have more money at retirement than the lower income spouse. And at retirement, they're going to be taxed at much different rate. So what we want to do is while we're working, start shifting money from one to the other. So at retirement, right, we will be about even and we will pay less tax once again as a family. So the higher income family member can provide funds to the lower income spouse and invest in a TFSA, tax-free savings account. These are one of the rare times that the government doesn't slap your hand when you're gifting money to a spouse. Because typically, if you give money to your spouse to invest and your spouse invests in whatever, a GIC, a stock, a rental property, and they generate income, the spouse generates income from the money that you gave them, then the tax will be attributed to you, the person that gave the money. So typically, you do not want to do that. Even though you're free to give money to whoever you want, unlike the US, in Canada, we don't have a gift tax. In the US, you could only give to your spouse or family member up to $16,000. If you give more, then they slap you on the wrist and you have to pay taxes. Now, you could give money to whoever you want in your family member and they could spend it for lifestyle expenditures. They could buy a car, they could go on a trip, they could do whatever, no tax implication. But the moment you give them money and they invest that money and they invest it in stocks, in bonds, GICs, mutual funds, rental apartment, you name it, the moment you give them to them free of charge, then whatever gains that they generate from the free money that you gave them, you're going to have to pay the taxes. So you want to be careful about that. One of the rare times that when you give money to a family member and it's not put on your tax return is when you give them money and they invest those monies into a tax-free savings account. That is one of the rare times that they will allow you to do that. There's a couple of other instances, but it's beyond the scope of today. If this strategy intrigues you, then by all means you could connect with me at another time. A last income splitting strategy would be if you are receiving child tax benefits, either from Ontario or or from Canada, then what you should do, if possible, if feasible, is use the child tax benefit amount. So I think in Ontario, it's about maximum about $1,400, depending on your income. So it's income tested. So take that money or whatever the amount of money that is being provided from the child tax benefit and invest it in the child's name, right? Regardless of how old the child is.
Oh.
If you invest it in the child's name as opposed to you taking that money and invest it in your name, the income that's being generated, so if you bought a GIC and you receive interest income, or you bought a mutual fund and you did fairly well with that mutual fund or stock, it will be taxed in your child's hand. Your child is not working, so therefore you file a tax return for your child and they pay no tax because they have no other income. As long as the income that is being generated, right, is not more than $13,000, then your child will not pay any income tax. So you're basically investing for the family, for your child, and not paying tax on the growth of that investment. So you're further income splitting. Okay. So far, so good?
Yeah.
Okay.
Yeah.
All right. Yeah. Sometimes I feel I'm in a vacuum, so I just want to make sure I'm not going too fast.
Sure.
Okay. All right. Another another income splitting strategy is a spousal RSP, and you probably have heard of spousal RSP. So this is an RSP for your spouse. So again, spouse is either legally married or in a common law relationship. So basically what you're doing is that you are in a high tax bracket. Again, your spouse is in a low tax bracket, and you want to still get the tax break. I still want to get the tax receipt. I love my wife, but I want the deduction. But I'm creating RSP assets for my spouse. I get the deduction, but it's now becomes my spouse's or my wife's RSP. And as we get older, her RSP or RSP assets will grow so that in retirement, our assets will be hopefully about the same. Okay. Now, in this situation, you only have one RSP contribution room. So don't think that you could contribute. So let's say your RSP contribution room is $10,000. So the government says, Pierre, the maximum you could contribute this year towards your RSP is $10,000. So that says that's the maximum I could contribute. I could choose to divide that 10,000 between me and my spouse. I could put, 1,000 for myself and 9,000 for my spouse. Any combination that equals 10,000. I cannot put 10,000 for me and 10,000 for my spouse. There's only one room, and I get to choose how I'm going to split it, what the percentage is I'm going to split. Okay, so this is a great way if you have a lower income spouse for them to, start building their RRSP assets. Or if your spouse is, does not work, stays home with the kids, you could still do that. You don't need to have income. Your spouse doesn't need to have income for you to provide a spousal RRSP. Okay. Spousal or family members loan. This is a more intricate one. Another form of income splitting. So this is a lot of people have, usually tell me that this is really more for rich people, but this could still be employed by, the average Canadian like myself, right? So basically, again, we have a high income spouse and we have a low income spouse, right? So remember, if I give money to my low income spouse, and my low income spouse invests the money that I gave to them, I'm going to be the one that's taxed. All right. So that's not a good thing. But if I lend my spouse the money at a very low rate, and right now, the low rate, which is known as the prescribed rate, is 1%. So instead of giving my spouse, the money for her to invest, I'm going to lend it to her. And I'm going to lend it to her at 1%. Now, when my spouse invests the money, she's the one who's going to be taxed on the growth and not me. And that way, as a family, if I would have invested the money instead of giving it to her, I would be taxed way up here. But by lending the money to my spouse and she pays me interest, she's the one who's gonna pay the tax, and she's gonna pay the tax based on a lower amount. So here's how it would kind of look like, just to give you an example. All right. So you lend money to your spouse, and your spouse will invest in whatever: stocks, bonds, cryptocurrency. GICs is probably not a good one because the interest rate on GICs is so low. I mean, it wouldn't make sense. I lend my spouse some money at 1%, and you get a GIC at 1%. Yeah, kind of defeats the purpose. But if you could generate more than that, right? So my example at the bottom, where third bullet, where it says I'm spouse number 2, and I'm going to lend my spouse number 1 $10,000 at 1%. So now my spouse number 1, she has $10,000, and she invests in, mutual funds, stocks, bonds, a portfolio of stuff, and that those funds generate a return of 7%. Let's say, for example, average return 7% for the year. So therefore, $700 of income would have been received this year. So instead of the $700 of income being taxed under my tax return, it would be taxed on my spouse's tax return, and she's making a lower income. So therefore, we would have more money left in our pocket. Now, for this to work, my spouse, she has to pay me interest. So in this case, she would have to pay me $100 interest a year, which is $10,000 times the 1% loan rate, right? So she would have to pay me at least $100 a year, right? And that $100 in interest that my wife would pay me, that would be added to my income as interest income. So as a family, I just save $600, because if I invested myself, I would have to pay the $700 of income. I would have to add $700 worth of income. In this situation, my wife has to add $700 worth of income, and I only have to add $100. So really, I save taxes on $600. Now, the reason I say this is, rich people do this a great deal. Add more zeros, and then you'll see how this becomes very much applicable, right? And a lot of times, so you take the $100,000. Gene just said I'm firing my accountant. Gene, you make me laugh, and I'm not an accountant. So Astrid is on the call, so you could always talk to Astrid. She's the accountant. What I enjoy to do is looking at ways legally, so I pay less tax on an annual basis. Because one of the things about our tax system is that tax avoidance is what we're doing is legal. Tax evasion is illegal. That will get you a slap on the wrist. But tax evasion, taking advantage of rules that Revenue Canada or CRA has placed for you to utilize, is perfectly legal. And this is definitely one of the things that one could do. All right. Donations, right? Donations. This is another great one that you could do. Little used, but this is great. You could donate to a registered charity, and you got to be careful, right? That charity has to be registered, because you could give me money, right? You could give, you could donate money to, to Pierre Tomachek's, house fund, right? I'll give you a tax receipt. I'll give you whatever you want. I'll sign whatever you want, but I'm not a registered charity. So as a result of that, you're not going to be able to take advantage of the donations tax credit. So if you donate to a registered charity, and you'll know because they'll have the registered number, right? And then you always take, write down the registered number and then Google it and then see if they are a registered charity. So if you donate to a registered charity, the first $200 of donations is taxed at 15%. And then any amount above 200 that you donate, the excess will be taxed depending on your tax bracket. So if you are in the highest tax bracket, so that is you're making in excess of $214,000 in Canada, then the tax rate that you're going to use for that donation is 33%. If you're below the highest tax bracket, then you're going to use 29%. Okay, so if I donate $1,000 to charity, I will be entitled to $262 tax credit. And the beauty about a tax credit compared to a tax deduction, which an RSP is, a tax deduction, is that a tax credit reduces your tax payable dollar for dollar. So if I owe $262 of federal tax to the government, and I utilize that donations tax credit, and that gives me 262, I have zero tax liability now. So this is a great tool when you could generate a tax credit as opposed to tax deduction. It reduces the tax payable federal and provincial dollar for dollar. So to do the math on the first $200, you multiply it at 15%, so that gives me a $30 credit. And then on the excess, the extra 800, it's taxed at 29% because I'm not in the highest tax bracket. So now I get 232 on the 800. When we add the two together, that is my tax credit. A good rule of thumb, you want to compile your donations until they reach over 200. If you have this year only $50 worth of charitable donations, don't use it, because you'll waste it. You want it to go over the 200, so you could carry forward up until 5 years your donations tax credit. Once it goes over the 200, then it's where there's a bang for your buck. Then you could take advantage of that, because if I donate $200 every year to my to to a charity, and I don't compile it and keep it so it goes over 200, that means every year I could only claim $30 tax credit. So 30 times 5 years equals 150, as opposed to if I had waited and added them all up, I would have been able to use $262 as a tax credit. So you could lump your donations and your spouse's donations, compile them, make sure they go over $200. And what I would do is I would give the tax credit if you are in a common law, or if you're married, I would give the tax credit to the higher income spouse, because they will have a bigger bang for their dollar. Now, here's another aspect that you should do with regards to tax credit. Like I said, you carry forward up to 5 years. If you are like our family, or a member of our family, which will go nameless, who goes to church religiously, right, and donates on on a weekly basis, get a tax receipt from your church. Get a tax receipt from your church, and instead of donating money uh, to the church, maybe you could either give them a check or put your name, put the money in an envelope and write your name and address, so that way at the end of the year they could tabulate exactly how much you gave, and they will give you a tax receipt for the total amount of donation. So if tithing is part of your of your norm, then by all means maximize that. Do the good work, do the Lord's work, feel good about it, but also get a tax donation, a tax credit for it. But you need the receipt. You would need to have some form of receipt to back it up if Revenue Canada ever comes calling. So definitely ask your church if they're a registered charity, and you may want to make sure that you keep track of exactly how much that you donate. Now, if you're not able to donate cash, there are some charities that will take certain assets. So remember when we talked about in-kind contributions like RSPs and so on, so we don't have to give cash? We could do the same thing. Instead of donating cash, you could donate certain assets. And they will take the assets, figure out what the fair market value of that asset is, and they will give you a tax receipt for that asset. So I remember years ago, my 2001 Chrysler Pacifica just died on the road. It just died. Over 400,000 kilometers. I couldn't squeeze an extra kilometer out of it. It served its purpose. Um, had I took the Pacifica, I brought it to the scrapyard. They gave me $100, and I felt good. Had I given this to Kidney Cars or other charities that take your unwanted vehicles, they would have given me a tax receipt for the fair market value of the car, not the scrap value that the scrapyard gave me. They could have potentially gave me a tax receipt for about $1,000, and I would have done a good thing for the charity, and I would have saved myself a few bucks, as opposed to getting that $100, and next thing you know, the $100 in my pocket, and you know what happens when you have money in your pocket? You spend it. So it was all gone. Now, there are charities that will also take your electronics. I've got tons of laptops, and I just found out about this charity called WorldCom Jamaica, and they take or gently used or laptops or electronic devices, and they will refurbish it and then send it to youth in Jamaica for them to use. And not only are you doing a good thing, but they will also provide you with a tax credit. So instead of taking your laptop and putting it into the landfill, right, give it to them and they will give you a tax receipt about that. Okay, perfect. And also, you could also transfer existing shares or mutual funds. So if you want to give your portfolio to a particular registered charity, you could do so also. And you could just transfer your mutual fund, your stock portfolio, and the government will make it easy for you. So if you have any capital gains that have accrued as a result of that, they'll say, Pierre, you're doing a good thing for the community. We're not going to charge you capital gain. You won't have to add it to your income, and we'll give you the tax credit. So you're getting kind of a twofer as a result of that. Okay. We're on the home stretch. Number 8, tax loss selling. So tax loss selling involves selling investments that, you know what, they're they're your dogs for the year. You've lost money, right? So in my case, it would have been Bombardier stock or Nortel stock. So if you've lost money on a particular investment, it's getting close to December, and you know what, I've lost, let's say you've lost $1,000, on paper, you haven't sold yet, but you're losing $1,000 on this particular investment. You could crystallize the loss by selling it, and now you've got a loss, and then you could take that loss and use it to offset a gain that you've made with another stock. So if you made money on your Tesla stock and you lost money on your Bombardier stock, right? You could take the loss from your from your Bombardier and deduct that against the gain that you've made on your Tesla, and that will lower the amount of gain that you would have to pay for this year. And if you have more losses than gains, I've got more losses, so I'm not able to use all of my losses from my investments, right? Then what happens is that you could use those unused losses. They have a funky name. They call it net capital loss. But you basically what it is, it's unused losses that you could use for future years, right? You could carry it indefinitely for future years so that in the future, when you make money from the sale of an investment, sale of a rental property, sale of everything, anything that could go up in value, you could use that loss to offset against that particular gain. Or if you want to, you could apply it to gains that you had the past 3 years. So I've lost money this year on Bombardier, and I don't have any gains this year. So I could use my loss from Bombardier for 2020 against my gains that I've made in 2019 tax return, 2018 tax return, and 2017 tax return. It's up to me to determine which one. And because I'm going to do an amendment for those tax returns for the past 3 years, I'm going to get a tax refund back because I would have paid more taxes than I should in those years. So take advantage of your losses is not necessarily a bad thing. If you know that, you know what, that stock is never coming back, right? That investment is never coming back. No need to hang in there. Crystallize the loss. Now you've got the loss. So in the future, when you have a gain, you could use that loss against other gains in the future. All right. All right. For the more aggressive investor, number 9, borrow to invest. So if you are an aggressive investor, and it doesn't really have to be aggressive because borrow to invest can means, you're buying a rental property, right? So if you're buying a rental property, is it that much aggressive? Some could argue, but you could borrow from the bank to invest in any type of investments that will have the opportunity to potentially go up in value. So if you borrow to invest, the interest on the loan that you've borrowed from the bank, so let's say you've borrowed from your line of credit, you could use that as a deduction. So for example, you borrowed $50,000 from your line of credit, and your line of credit is at prime plus something. So let's say it's at 4%, and you invest in a mix of mutual funds, stocks, and bonds you pick. All right. So now the annual interest that you're going to pay on that on the line of credit is $2,000 because you're going to choose to pay only interest only. You don't want to repay the loan too quickly. In this instance, this is not like a mortgage where you want to pay it off as soon as possible. Now, you want to take advantage of the annual interest amount. You're going to use that as a deduction. So $2,000 will act as a deduction from your income, similar to an RSP deduction. So the $2,000 of interest income that you paid will reduce the amount of your income. So let's say your income for the year is $70,000. The $2,000 will reduce your income from 70 to $68,000 and save you a bit of taxes as a result of that. So this strategy works for non-registered investment. If you're going to borrow to buy a rental property, not borrow to buy your principal residence, unfortunately that doesn't work. Only to invest in passive types of investments, then you would be able to write off the annual interest costs. This strategy unfortunately does not work for registered products. You could still borrow to invest into a TFSA, RSPs, RESPs to take advantage of the carry forward, but you will not be able to deduct the interest. So this is only available. This is only applicable for non-registered investments only. Move-in expense number 10. You can make your move count. So if you're going to move, and I know some of you, I know a couple of us in this, I know one person for sure, he will rename nameless, client of mine who is looking to move, and he's gonna, if the move is gonna be 40 kilometers closer than your previous workplace, then you might be able to deduct some of your travel and moving expenses, right? In this situation, you want to keep your records. You want to keep your receipts. So some of the meals may be deductible if you had to stay in a hotel, or the various trips that you had to make to go from here to Windsor, that would be applicable. Also, if you have students, if you're a student and you're moving to McMaster, you're going to McMaster University up in Hamilton. So that's more than 40 kilometers away from the GTA. Then some of your moving expenses, you could deduct that as some of your eligible moving expense, you could deduct from some of your income that you might be entitled to receive from bursaries, scholarships, and fellowships. So that is also applicable for students, but you have to be enrolled full-time. All right, so that's the top 10, but here are some bonus tips. Tuition fees. So we know the standard tuition fees, for our kids. That's not the one that I'm talking about. You're still eligible for those, but tuition fees would be, courses that you would take at, any post-secondary institution. They will qualify for a tuition tax credit. And that's as long as it's taken at a post-secondary institution, right? And you are 16 years or older, right? And you're taking this course to, develop, improve your skill, right? And that course is certified by the ministry, then you could deduct that course cost against your income as tuition fee deduction. Professional dues also. So if your industry, like mine, you need a certain designation or a certain accreditation to be in your particular industry, you've got to pay dues. Mine is the CFP, the Certified Financial Planner. I just had to pay $531 to renew my CFP designation every year. That $531, those are my annual professional dues. I get to deduct that against my other income. So if you belong to a union, also you have annual union dues that you could also deduct as a result of that. So if you are a project manager, and one of the designations for project manager is the PMP, the project management professional, and you pay union dues, you could deduct that. If you're a certified HR representative and you have the CHRP and you pay union dues, you pay professional dues, you could also deduct that. That's it. Questions?
Well, can you hear
Oh,
me?
sorry. Any?
Hello.
Yeah, yes, go ahead.
Hello.
Yeah, I can hear you. Who's that? AR? AR? I could hear you.
It's
Yes.
Khan. It's Khan. Yeah.
Yeah.
Okay.
Hi.
So I just wanted to know that would I be getting the recording of this webinar?
Yes, I will. I will provide the recording. If you would like to just put on the chat, on the chat, if you want to just put it privately, your email address, I will provide everyone with copy of the presentation, webinar, and so on. So you will have a copy of that.
Did you get my email address?
Yes, I did, and I'm seeing a lot of people are doing that. Definitely.
Yes.
All right. You're sounding. Your sound is a bit. Any? I don't know if you had any more questions, Mr. Khan.
Thank you very much.
Oh, you're welcome.
That's
You're
it.
welcome. You're
Thank you very
welcome.
much.
Anytime. I'll give you also. You'll have my. You have my. My information. So if you ever want any any questions, don't hesitate to give me a call. Yes, Gene, if you have a
It's
question
not
or
really a
something.
question, but
Yep.
it's interesting. You had some really good pointers on tonight, and one that I wasn't really aware of
Mm-hmm.
is you can crystallize your losses. I kind of knew a little bit about it,
Mm-hmm.
but when I said I was going to fire my accountant,
Mm-hmm.
it's really good to attend sessions like these so you
Mm-hmm.
can learn this information,
Mm-hmm.
because my accountant would not know. For example, I have in my RESUP portfolio,
Mm-hmm.
recently retired from the bank, and I
Mm-hmm.
have a
Mm-hmm.
pension portfolio,
Mm-hmm. Mm-hmm.
and a part of my bank stocks was at a loss
Mm-hmm.
all of last year.
Mm-hmm.
And I could have cashed that out in
Definitely.
kind
Mm-hmm.
and crystallize the losses
Mm-hmm.
to use against capital gains, right?
Now
If that
here's
is,
here's the one thing. Here's the one thing. When you said when say about crystallize and you said transfer in kind, what you would have to completely sell your RBC stock, I would imagine you would have to completely sell them and not repurchase them for 30 days. There's such a thing called a
oh,
superficial
right.
loss. So
Yes,
you don't want
I've
that to
heard about
happen.
that.
Yeah. So, but if you've taken a look at bank stocks like I have, they don't gravitate, they don't move that much within a 30-day window. So you could take advantage of that, right? So you sell your bank stock, right? And then you repurchase it back 31 days after, and
Ah,
there wouldn't have been that big of a fluctuation, right? And then you'll be able to take advantage of that. But definitely, but not to fire your accountant. Here's the thing, right? A lot of
but
times,
he wouldn't have known. Whereas if I knew this, I could have
yeah,
taken advantage of $5,000 in losses. He
yes,
wouldn't know what's in my portfolio. So
that's the
my
thing.
point is,
That's right.
it's
Yeah,
really good to
yeah.
attend sessions like these so you
Hmm.
know
Hmm.
yourself, and you
Hmm.
can say to your accountant, hey, I
Hmm.
have these stocks and I'm 5,000 in the hole right now.
Hmm.
Can I take advantage of what Pierre just taught me?
Yeah, no,
you
definitely,
know? Yeah.
definitely.
Well, thank you for that.
Oh, you're welcome. I just have a question. Someone have just sent me a question. If someone's moved to Canada from the US, do they have to file taxes in both countries? Yes, I have a client right now out of Hamilton, and he is a resident of Canada, so he now lives he now lives here. Met his wife to be here, and he is still a citizen of the U.S. and he's not going to give up his citizenship. So yes, he's going to have to file 2 tax returns every single year until he ever wishes to relinquish his US citizenship. And he doesn't want to do that, and most Americans do not want to do that. So you will have to file a tax return in both countries. Doesn't mean that you're going to pay taxes twice. The Canada and the US, we have a Canada and US tax treaty. So what typically happens is that the US, they like to get their pound of flesh first. So you're going to pay the tax owing first to the US. And then for the amount of taxes that you've paid for the US, when you're going to file your tax return in Canada, you're going to get a credit for that in your Canadian taxes. So you're not going to pay taxes twice, but it's a pain. You have to file a tax return twice, one by April 15 in the US and the other one by April 30th in Canada. And for that, you definitely want to have an accountant take care of that, because there are some forms that you need to do. If you if this is pertinent, you could definitely connect with me, and I could connect you with some cross-border accountants, and I could also provide you, if your taxes are fairly straightforward, I could also guide you as to the forms that you need to complete on an annual basis. Okay. That's it. Is that all the questions? Oh, Cecil has, oh, sorry, I didn't see that one. Thank you. So for the professional dues, how many years back? Oh, 1 year, Cecil. 1 year, Cecil. Yeah. So it would be for 1 year. Okay, that you could claim it back. Have I missed any other questions? So be on the lookout. There will be more webinars like this, where we will be inviting guest speakers to speak about their various specialties. One of the other upcoming ones will deal about starting your own business, and the benefits of starting your own business. And also taking a look, we had recently a seminar about buying rental or your principal residence. So that will be also available in the months to come.